Lotus Ventures Inc. is a BC-based medical marijuana company poised to launch into the rapidly evolving cannabis sector. Lotus is in the final review stage of the Health Canada approvals to become a licensed producer, having arranged facility financing of up to $12 million, plus building permits for its prototype indoor production facility. Shares trade under the symbol J on the Canadian Securities Exchange. Visit our website at lotusventures.ca.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome back to the show, Bob.
Yeah, Jim, good to be with you.
The Dow Jones hitting record highs up until the last couple of days. Is this the start of a major correction or just a minor bump?
Well, Jim, actually the run in the Dow was very consistent. Quite unusual, some of the statisticians are saying, for that consistent a run with hardly any correction. And that's showing a couple of things. One is that the action is coming down into fewer and fewer of the leading stocks. There are other participants, but they've been falling by the wayside. So, but when we take a look at it on the Dow, the run was strong enough to register technically some excesses. Our upside exhaustion reading, and that's momentum, or relates to momentum, and then also we got a sequential sell on it, which is pattern. So, how much farther does it go? I don't know, but the main thing is to distinguish between these technical features and today's sell-off, and yesterday's sell-off, which is news-related with the concerns about what's going on with North Korea. So, the point being is that the excesses were in the market before the bad news came, and that was the opposite to what we had in early November, where the markets were down, and our technical work came in with a springboard buy. That was on November the 3rd, before the good news of the election. And, of course, the good news of the U.S. election was that a pro-business administration came in and displaced the possibility of yet another and more severe socialist government in the United States. So the market was poised in early November to rally, and the market has been poised to sell off now, and you got some bad news with it. So how long the bad news will last, nobody knows, but the main thing is that you've had now enough technicals at about the right time, and by the right time I mean we had earlier in the year, when we got the buy in April, figured, okay, this one is good, and perhaps a speculative thrust up into June, which we did get. Some of the technicals were outstanding. And then after some correction, then another rally, particularly in the U.S. market, out towards September. So this is where we can say, is the market up when it should be? Yep. Are there signs of speculation? Yeah, there's another one set of indicators have come in. And so the financial market, the stock market is vulnerable. Now this is, Jim, just on its own measures, like the upside exhaustion and the sequential sell. But of course, you want to look beyond the stock market at other things, and this is where our work in the credit markets becomes valuable, is that everybody parties in the financial markets, although in a bubble, the stock market gets most of the press. Underneath it is some outstanding speculation in credit markets, and one has been with the flattening of the yield curve, which ran as far as it's going to go, and it's now been trying to reverse. And then you also had the credit spread narrowing, and just looking at the high yield, the HYG, earlier in the week, that latest rally on that one gave a sequential sell, which is kind of nice to get, a really good excess on that one. So the stock market is now vulnerable to changes in the credit markets, and one of them particularly is that you've had one of the confirmations of a bull market is that short-dated Treasury bill rates are going up, and that's a sign that there's a demand for speculative money at the short end for speculating in whatever game is on. Now that got up to 1.18%, which is not high in historical standards, but it's come a long way from sort of 0.18% a couple of years ago. It also had some technical excesses on it. So now we're looking for the 3-month Treasury bill rate to decline. And why are we focusing on that? Well, let's go back to 1929 when the 3-month Treasury bill rose to a little over 5% then in May of 1929, and in June had reversed to heading down, and then that was the early sign on the credit contraction that started in that September. So the other ones we look at on the credit markets is the spread between high-grade bonds and low-grade bonds. And when you're in a bull market and everybody's confident, the spread's narrow because risk no longer becomes a consideration. So, spreads narrowed into a couple of months ago and have turned to widening. So we were watching for the first breakout in widening, which occurred in late June. And then you've had the correction on that, but now we're looking for the second breakout in credit spreads. And the two steps, first breakout and second breakout, worked for us going into the peak of the market in 2000 and also into the peak of the market in 2007. So we're not dreaming about this stuff. This works. So this we have. Now then there's one other sector that is worth reviewing, and that's the industrial commodities. And you've had pretty good rally in crude oil. Good swing in the momentum, and is now vulnerable to firming the U.S. dollar and possible credit problems in the fall, plus the same old seasonal low for crude out in December, January. And then, as I'm just noticing now here, crude oil's down a fair amount. It's got hit. And then you look at the base metals, and they've had a really good run, and are a little overbought and ready for a setback on both and also on the base metals. Like if you take a look at copper, it can often set an important low down into November, December. So that's something to consider. So, but you had in the crude oil market, the oil stocks had their peak in February. A really good rally out of the disaster into January 2016. Rallied up smartly, and they got overbought then, which we noted, and really have been disappointing since. So that's kind of like a negative statement on the actual price of crude oil itself. And something similar with the base metals, which really did rally well this year up until a few weeks ago. And then now they are taking a little rest, so they're not confirming the recent high, this week's high in base metal prices themselves. So there's lots to be concerned about out there, Jim.
We'll have more with Bob Hoye right after the break.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the U.S. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the U.S. and GET in Canada. Find out more at glancepay.com.
Welcome back. We're chatting with Bob Hoye. Bob, we're in earnings seasons, and most of the stocks that we see, people say we've outperformed our predictions. We're doing great. We're going to have a better year than many thought we would. Are we getting lowballed to start with, so these earnings just look good?
Yeah, there's a chart that a friend of mine updated. It's a good way to value the stock market. Take the S&P and you divide it by the average monthly wage. So you end up with the number of hours it takes to buy a unit of S&P. So it got up to, I think, 108 at the extreme high of the dot-com bubble in 2000. And just to put this in perspective, at the bottom of the bear market in 82, when then this new era of inflation and financial assets started, that was down to 4. It took 4 hours of work to buy an S&P. So when it hit 108 in 2000, now recently it's up to 112. And at the peak in 2007, it was up to 80. So this is a really good valuation on the stock market. Now, what you have with the analysts, and I have been a stock analyst, fund managers and individuals want to buy the stock market. They want to be long the winning game. So you've got the standard measures against earnings. The PE multiple is exceptionally high on a trailing basis. That's reality. That's based upon what has been reported. But the job of some stock analysts is to try and make the stock market look cheap. So then it rationalizes buying at elevated prices. So back in 2000, they were playing a haywire game on some of those dot-com companies that were sort of trading at 200 times sales. And what it was is the company would whisper, that was the term, an earnings estimate like per share. And then that was lowballing it. So then when the earnings were announced at 1 cent higher than the street expected, that was very exciting, and they bought the stock market. Now that was a form of moral relativism that, hey, it's better than what we thought. Now here, this is also coming into play. They're finding ways to make earning statements more attractive than they are, and it is to try and make a very expensive stock market look buyable, and it is, I'm going to say it, Jim, it's disgusting. So we'll see how that one works out. But there's no way you can get around the other kind of valuation, like how many hours it takes of work to buy the S&P. And my friend Ron Grease does that one at the chart store. And he also has done it against gold when gold was very high. Or, you can run it against anything. And it's worthwhile looking at, and it's exceptionally high. So the stock market is, by a number of measures, extremely high valued. and it's also got now momentum, and it's got pattern. So, and seasonality. On the bull markets, on the seasonal annual pattern for the S&P since 1982 to recent, there's a tendency to put in a pretty good high in the latter part of August. If you take that same sort of analysis and started at an earlier date, it was sort of into September. So we'll see what's going to happen here. But the stock market is unusually vulnerable, and it has been made so with this summer's rallies. So type thing. And it's going to be fascinating to see how it all works out.
Bob, when we come back, we'll be answering a couple of questions from Frank de Beer in Belgium.
Very good.
I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario. With grab samples running as high as 32 grams per ton gold, a drill program will commence this spring to test the numerous targets located by recent groundwork. For more information, visit our website, rmroyalty.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're talking with Bob Hoye. Bob, one of our best listeners, Frank de Beer in Belgium, has a couple of questions. Bob, from what I understand, you expect the post-bubble contraction to create a bullish environment for the gold sector. Do you expect the low for the sector to come after some excess is cleared from Wall Street, or only after the ultimate bear market low for Wall Street is in?
Yeah, Frank, good question. We can just rest on history here that in a bull market, or in a bubble, the real price of gold has gone down. That's relative to the CPI or the PPI. And gold has drifted down over the last while. It's not been a sharp decline of late. But then when it goes up, that's a reflection on earnings. And in every post-bubble contraction, the gold sector has done very well because the real price of gold goes up and the miners make some money at it. So it becomes a good game. Now, however, for the gold stocks, they're going to be vulnerable to a problem in the big stock market here. Now, the other problem you got with gold is that in a post-bubble contraction, the senior currency becomes firm relative to most other currencies and most commodities for most of the time. But recently here, my colleague Ross Clark has noted that gold was a little oversold. And on the page I write, we're looking for commodities, industrial commodities like base metals and crude oil to be firm into August, and that would probably help with gold and silver, which has been the case. Silver's been rallying faster than gold. So, but this particular move, I think, is not going to run too long, and then the gold shares will be vulnerable to a problem in the big market. So we would watch for a terrific opportunity in the golds. For most of this year, we've been writing that our comfort in the gold stocks rests upon gold outperforming, the gold stocks outperforming the bullion price itself. That hasn't been happening. And the other one would be silver outperforming gold. But until this week, that hasn't been the case either. So we'd continue to stand aside on the gold stocks and wait for opportunity to come in and comforts and all kinds of technical stuff. I think these measures, Jim, are reasonably reliable, and we would wait for an opportunity later in the year.
Another question from Frank de Beer. Once the bull market in the gold sector gets going, is it possible that it eventually matures into one big excess, just like we see now in the NASDAQ? In other words, are we going to see the FANGS stocks of the gold sector?
Hey, Frank, you got it. Yeah, in the past, within the post-bubble contraction, the gold shares are terrific. For example, Homestake was the premier producer in the late 20s and in the early 30s, and the stock, you could have bought it for $9 into 1930, 1931, and then it started to move on the real price of gold improving, and the stock rallied, about 135%, if I recall rightly, before Roosevelt raised the price of gold in March of 1933. And also I noted that the increase in gold's real price was about in that order too, something like 130%. There was no change in the price of gold. It was still fixed at $20.67 an ounce. So, and the stock, as I say, 135% gain in the senior gold stock when the rest of the market was showing negative returns. And then, of course, once the U.S. devalued the dollar against gold and moved gold up to $35 an ounce, then eventually the stock went to $35 from a $9 purchase. Now, also in those days, the senior gold producers paid out most of what they earned by way of dividends. So through the 1930s, Homestake was paying $4.50 a share on an original $9 purchase. And, of course, the exploration side was very strong, and junior stocks were flying absolutely fabulous. So, yes, Frank, the gold sector in time can become as exciting as has been the high flyers on this bull market. Maybe not the same percentage gains, but it will become the darling of the marketplace. And, I'm looking forward to it.
Bob, thank you so much for chatting with us.
Yeah, Jim, and we'll look forward to talking next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. You're listening to HoweStreet.com radio. Find us on Twitter at TalkDigitalNet. Our very popular YouTube channel is Talk Digital Network. And if you have any questions for our guests like Bob, you can send them to info@HoweStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of Howe Street Media Incorporated.